Well, it seems like it could be a good thing if everybody if you come to a positive agreement. Say, I'm checking to see if I understand you right, Reggie Pittman. I own a piece of property um, on a lot. The property needs a lot of work, and instead of me fixing it up and then finding a tenant, I find the tenant first, and the tenant does the fixing up and puts a lot into it. Then then I should I'd be very willing to give him a lease, and make it worth his while and my while as well, because he's doing all this work for me that I didn't want to do for myself, and now I'm going to get rent from him for a certain amount of time. It'd be just fair to give him a lease, and business leases are often long term. They're not just 1 or 2 years like when you rent your home. So 10 years, I think is would be at the minimum if somebody's going to put a whole lot of money into a spot.
Okay, can I say something off yet? This is Denise again.
Please.
Typically, that's more, I know you guys are talking about residential real estate, and I'm more experienced on the business side, on the commercial side, because I've been doing commercial real estate for a long, long time. But typically, if you're in commercial real estate, when a landlord owns property, if someone wants to come in and lease it out for a business purpose, if you don't negotiate into your lease where the landlord will contribute towards the build out of your space, the responsibility of building out that space is yours totally. And you get to indicate in the lease, what you can take. Usually any fixtures that you attach to the property stay to the property, but you have the right to remove anything that's not a fixture when you leave the property. But it's typically the lessee's responsibility to go in and build out and improve the space in a business setting.
Right.
Yeah.
And I guess it's good to mention that, commercial loans, they have a whole different set of rules than residential loans. I mean, the responsibility on a commercial loan, I mean, if you fall behind on your payments, man, they can come and take your stuff for real. Whereas with residential, Fannie Mae government, you have a certain degree of protection. It's not as there's a process for foreclosures and to take someone's property, which is a little more lenient than a commercial loan. So also, I think that I don't know the stats or the numbers, but I think the loans that tend to foreclose the most probably are commercial loans. Because people, who are buying their homes, they're in for the long haul, 30 years. In fact, I think just recently commercial loans started to offer 30-year fixed. Prior to that, I think it might have been 2, 3, 5 arms, all kind of these situations. Don't quote me on that, but I think so. So when I said earlier that that's a situation I probably would avoid, it's a whole different ball game, and it requires a certain skill and knowledge to be successful in that situation versus single family residential, or even multiple family under 4 family.
There's one thing that we haven't talked about much, which is tax benefits, right? So if you own a home, you have tax benefits. So that means you can deduct the interest expense from off your taxes, right? You can if you have a workroom that's yours, you can deduct that off of part of your taxes because you're the homeowner. If you're renting, it's a different situation. So you can do it if you're renting, but it's a different situation. Then there's the capital gains itself, where if you buy the house and there's you have to pay capital gains because you made a profit of 250,000. So then if you have it through a company, then you can pay 20% instead of 33%. That's a little more. Yeah, that's something that you learn as you go, right? I learned it after I had to pay some capital gains. So I said, I didn't think capital gains would hit me, but it hit me, and I was like, oh man, I heard about this capital gain. So as you go in the game, you learn the game. So that's something that you should be aware of, right? So there's a lot of tax benefits once you're in the game. So we're trying to educate you as before you get in the game, know what's coming down the pike, because it's coming down the pike. Whether you want it to come down or not, it's coming down the pike. So be prepared. So the tax benefits can be great.
Did you want to talk a little bit about depreciation? I wish James Brown was on there.
I think James is on it. He's doing taxes right now. So James is.
No, I'm back. Yeah, I mean,
Okay.
depreciation is really just a concept, and it's really only comes into play if you're operating the property for business purposes, either with using it as to run a business or for rental income. So really, depreciation is a concept that says for fixed assets, meaning anything that has a useful life of more than 1 year, rather than deducting the expense up front, you depreciate it over its useful life. So let's say, if you bought a stapler from Staples, that's something that doesn't have a useful life of more than 1 year. So you deduct that entire cost up front. However, if you invest in a rental property, that obviously has a useful life of more than 1 year. And the useful life of various types of property are assigned by the Internal Revenue Code. So for rental real estate, that useful life is 27 and a half years. So to make it simple, let's say you pay $275,000 for the home, you rent it out, you can't deduct that $275,000 in the year, that you purchased the house. You deduct it ratably over the 27 and a half year period. So that's $10,000 a year. So, and that's sort of, I don't want to say it's hidden, but that a lot of times you hear people say that they have positive cash flow, but yet, or for tax purposes, they show a loss, and that's usually because of depreciation, which is a non-cash item, right? Because you already put out the cash when you bought the house, whether you pay in cash or have a mortgage or whatever. So let's say you have a net cash flow of $5,000 for your rental property, but then you get that depreciation deduction of $10,000 a year, right? Which is the 275,000 divided by 27.5, 27 and a half years. So that's $10,000 a year. So that $10,000 will generate a $5,000 tax benefit, right? Because you'll be showing a loss on your tax return, even though, you put $5,000 in the bank for that year. So that's that's an accounting concept, but it's important when you're trying to assess profitability, especially as it relates to investment properties. Like I said, it's not really important for purchasing a home, as your personal residence, but definitely if you're looking at investment properties, that's something that you want to factor in.
Yeah. I brought it up because I experienced it. My accountant, we talk about it and talk about how much depreciation I'm going to take this year as opposed to last year, and what my expenses were, and did I sell any property, all those kinds of things. And that's because I'm a rental investor. I have rental tenants here in Brooklyn and the other places. So it's important for the rental investor. But for yourself, if you're going to just own your single family home and live there yourself, no, yeah. Mm-hmm.
James, can you talk briefly about tax benefits of owning a home? The one you just mentioned one. We talked briefly about capital gains. I don't know if you heard what we said, and some other things.
Yeah.
So we just talk briefly about like tax benefits of owning a home, especially for Generation Z.
Right. So the primary tax benefits for home ownership is you get to deduct your mortgage interest, which can be substantial, especially in the early years, and your real estate taxes. So, you know, that helps you in the way the government is sort of subsidizing your purchase, right? Because you say, well, you know, if I'm renting, you know, I'm paying, you know, maybe let's say $2,000 a month, but my mortgage is going to be $2,500 a month. But a substantial part of that mortgage